Brad Williams, Frugal Finance, bottom-up betas. What are bottom-up betas? Let me just give a Reader's Digest version. Historically, we've used regression analysis to generate beta. We use historical data. The argument is there a better product that we can use that will provide better beta? In other words, is there something that will give it real-time betas? The bottom-up beta is a good attempt. And I've been using bottom-up beta for 15 years. Oswald DeMotorin developed this model. Some will argue that bottom-up betas is just a wild-ass guess and it's not any better than anything else. Look, there's a lot of different ways to skin a cat. You can use historical data, do a comparison. You want to argue this, then do an apples-to-apples comparison. In your valuation, use historical data, and then next to it, use the bottom-up betas. Use historic, bottom-up, and let me know what the results are long-term. In other words, do it now, and in 2 years, tell me what's better, bottom-up or historical. Breaking down betas into their business, operating leverage, and financial leverage components gives us another way of finding out betas, whereby we don't need past prices on an individual company or assets to estimate its beta. To build this improved method, we want to introduce an added feature that betas possess that proves invaluable. The beta of two assets put together is a weighted average of the individual asset betas, with the weights based on market value. So the beta for a firm is a weighted average of the betas of all the different businesses it is in. Thus, the bottom-up beta for a company, its assets, or its projects can be estimated as follows. Identify the business or business segments within the companies whose betas we are trying to figure out. Most companies give a summary of their revenues and operating income by types of business in their annual reports and financial filings. Calculate the average unlevered betas of other publicly traded firms that are primarily or only in each of these businesses. In making these assumptions, we have to think about the following estimation issues. Comparable firms. In most businesses, there are at least a few similar companies, and in some businesses, there could be hundreds. Start with a narrow description of comparable companies and broaden it if the number of comparable companies is too small. Beta estimation. Once a listing of comparable companies has been prepared, we need to figure out the betas of each of these companies. Optimally, the beta for each company will be estimated against a common index. If that proves unrealistic, we can use beta estimates against different indices. Unlever first or last. Let me go back here. I was saying we're using regression betas. Well, to estimate the bottom-up betas, here is the hypocrisy here. We're going to use regression betas to determine the bottom-up beta. And you're going, what? You just badmouth historical data. How does this work, Brad? Well, hold on, be patient. Unlever first or last. We can compute an unlevered beta for each firm in the comparable firm list using the debt to equity ratio and tax rate for that company. Or we can compute the average beta, debt to equity ratio, and tax rate for the sector and unlever using the median averages. Using the standard error of the individual regression betas, we would recommend the latter approach. In other words, we're just going to use regression beta. Median approach. The median beta across the comparable companies can be either a simple median or a weighted median, with the weights based on market cap. Statistically, the savings in standard error are larger if a simple median process is used. Adjustments for cash. Investments in treasuries, repos, and cash have betas close to or near zero. So the unlevered beta that we calculate for a business by looking at comparable companies might be changed by the cash assets of these companies. To figure out an unlevered beta, cleanse the cash, look at Microsoft, look at Apple. How much cash do they have on hand? It's going to be a huge variation if we don't take out the cash. So unlevered beta corrected for cash equals unlevered beta divided by 1 minus cash divided by firm value. The resulting number is sometimes called a total beta, indicating that it measures the risk of only the business and not any other corporate holdings. To calculate the unlevered beta for the company, we take a median of the unlevered betas using the proportion of company value derived from each business as the weight. These company values will have to be estimated because segments of a company generally do not have market values available. If you're not able to estimate these values, we recommend using operating income or revenue as weights. This median is called the bottom-up unlevered beta. In general, it is a good exercise to compute 2 unlevered betas for a company, one for only the operating assets of the company, and one with cash and marketable securities treated as separate business with a beta of 0. Calculate the current debt-to-equity ratio for the company using market values if available. Otherwise, use the target debt-to-equity ratio specified by the management of the company or industry debt ratios. Estimate the levered betas for the equity in the company, each of its business segments, using the unlevered beta. To see what I'm talking about, this is the general contractor section that I said you can tap into. Here is all of the different sectors. Here are the different companies. And you're going to see we have materials, we have construction supplies, we're going to have water, we have specialty engineering, etc. What I'm talking about in terms of breaking this down, here we're saying calculate the current debt to equity ratio. If you look here, we're going to have the levered beta, we're going to have the debt to equity ratio, and what I did is I took this information here, I-2026, and I took the median of I-226. Debt to equity ratio 2417. The unlevered beta, I just calculated the unlevered beta, and what I want you to do is just go in here. It's pretty simple, and I have the formula probably in here. Our cash value, unlevered beta corrected for cash, correlation with market, and then total beta as I am discussing. The information's here available if you want to review it. We were at number 4, calculate the current debt to equity ratio. I just showed how to do that. Estimate the levered beta for the equity in the company and each of its business segments using the unlevered beta from step 3 and the debt to equity from step 4. Naturally, this approach rests on your being able to recognize the unlevered betas of individual businesses. There are 3 benefits with using bottom-up betas, and they are important. We can estimate betas for companies that have no previous price history because all we need to do is identify the business or business segments they operate in. In other words, we can estimate bottom-up betas for initial public offerings, private business, and divisions of companies. Why? Because we have that industry information, the law of large numbers. In other words, we're going to have more accurate information and we're going to tie it to your private business, and then we'll make some adjustments and alter the beta based on the type of business. Since the beta for the business is found by computing the median value across a large number of regression betas, it will usually be more accurate than any individual company regression beta. The standard error of the median beta estimate will be a function of the number of comparable firms used in step 2 and can be approximated as follows. The average beta divided by the square root of the number of firms. So the standard error of the median of the betas of 100 firms, each of which has a standard error of 0.25, will only be 0.0025, etc. Okay. The bottom-up beta can point out current and more impending adjustment to a company's business mix and financial leverage because we can alter the combination of businesses and the weight on each business in making the beta estimate. We cannot estimate a regression beta for capital construction, a private firm, because it does not have a history of past prices. We can, however, estimate the beta for capital construction using the bottom-up beta. We list the betas of the firms as well as debt, cash, and equity. Here, I just showed you this information. We have company industry beta, market debt to capital, unlevered beta, cash, unlevered beta for cash. I think there's 35 companies here, maybe 38. What we're going to do is we're going to look here. We have a list, whatever, 116 minus 77 is what, 48? So maybe there's 48 companies here. Beta. We have median market debt to equity ratio. We have unlevered beta, cash firm, the value, and unlevered beta corrected for cash. Even though the companies in this example are very different in terms of market capitalization, the betas are consistent. To estimate the unlevered beta for the sector, we first unlever the beta. I'll show you how to unlever it here in a bit. We first unlever the beta for each firm and correct each unlevered beta for the firm's cash holdings. The median value for the unlevered beta corrected for cash is 0.83. Now, evaluating the bottom-up beta information, we have some data here. And again, we're looking at the law of large numbers here. And this should give us a better beta than if you use just regression beta. Here we have this unlevered beta and some of the numbers. So we have a levered beta for sector. Right here, you have to go all the way up here to look. We have 9.8. You can just put that here. It's just a starting point. Now we have a debt to equity. If we use a median, we're going to get 0. And that's not accurate. Even though you can see here, the median does look like 0. We're going to use some debt, all right? So I took an average. This is subjective. If you want to use 0, you're going to recognize what you're saying is this project is not taking on any debt. And it might not, because the structure is a little funky. We're using short-term debt, and with this 28.34, the results will do both. Evaluate and see what it does in terms of the final outcome. Then we have this unlevered beta, and we're going to take C125, which is the levered beta. Then we're going to take into account the tax rate is 0.25, it's 25%. And I noted that in the very first page where I had a bunch of assumptions. So it's 0.25. I don't have it noted here. That's why it's hard-coded. And then C126 is going to be the debt to equity ratio. If this is 0, your levered beta and your unlevered beta are going to be the same. We took cash into consideration. It's right here. I should just put this equals this. And it says 0.07%. And I use 7%. Sorry about that. So it's 0.07%. We're going to calculate the unlevered beta corrected for cash. We're going to say C127, which is already the unlevered beta. 1 minus this variable cash divided by firm value, 0.07. You could do this manually, and I have. You're just going to look at cash. You're going to determine firm value. Sometimes that's recognized as enterprise value. Sometimes you're going to just calculate it, crunch out this firm value, but EV is generally that number. Unlevered beta, 8.09. Correlation with market, that's something that's generated in the industry data. And then your total beta is going to be 2.27. C129 divided by correlation with market. So in this example, we're going to use 2.27 or higher. Brad Williams, Frugal Finance. Thanks for watching.